the PwC Center. I mean, it gives us great pleasure on behalf of the PwC partners to welcome you to this special forum on the Finance Bill. As some of you know, the Finance Bill was voted last week, and it was enacted last week, received assent, presidential assent, and it was voted without amendments. It's been a couple of years that we've been running this special forum. We typically hold it at the Finance Bill time because we wanted the special forum to be a platform where there was this interaction of stakeholders. So essentially, taxpayers, tax authorities, and tax professionals could meet to exchange ideas, to get perspective of some of the latest tax measures that's been introduced, so that essentially the MRA could take some of these views when formulating guidelines and policies. Last year, we've seen substantial changes to the tax regime, where we've seen the change in the global business sector, specifically where the deemed foreign tax credit system was removed, and essentially a new 80% partial exemption being introduced. Again, this year, we've seen further refinement to the partial exemption regime, along with some of the new regime, for example, control foreign company, the presumption tax, or some introduction of anti-avoidance regime around the VAT, for example. So we'll give the opportunity to the MRA to talk us through some of these legislative changes. Before we start the panel discussion, I'd first like to make an introduction to the panel. I, myself, Anthony Lungxing, Country Senior Partner of PwC and also the tax leader. I'll be moderating this panel along with my fellow partner, Dhiren Perlu, who is a tax partner within PwC. And from the MRA side, we have Mr. Hannelas, who is the Acting Director-General of the MRA today. And we've also got Mr. Oozeer, who is the Acting Director for the Operational Service Department of the MRA. And we've also got Madam Gunnoo, who is the Director of the Medium and Small Taxpayers Department with us. So together, they'll be sharing some of the insights and perspective on the latest tax policies. So before we go into the panel discussion, I'd like to allow Mr. Hannelas to say a few words from the MRA perspective. So, Mr. Hannelas.
Thank you, Anthony. I'm very pleased to be among you this morning. Director-General is on leave, so I am replacing him as Acting Director-General. Maybe before we start the discussions, I would like to give an overview of the changes brought by the Finance Act 2019. I will talk particularly of the main changes in income tax, and then I will pass over to Mrs. Gunnoo, who will talk about the changes, main changes to MRA Act and the VAT. So as you are aware that apart from increasing the income exemption threshold and extending the reduced tax rate of 10% to employees drawing just above the threshold, there's been also the review of some personal income tax allowance, introduction of tax holidays, and fine-tuning of certain tax regime. The key provisions has been as follows. We have to promote the development of the real estate investment trust rates. There are certain incentives that have been provided. For example, a collective investment scheme or closed-end fund authorized by the FSC as a rate is being exempted from corporate tax, subject to certain prescribed conditions being met. And a rate will be exempted from CSR, and the first 50,000 rupees of income received by an individual in an income year from a qualifying rate will be exempted from personal income tax. Soon there will be regulations where there will be conditions which the rate has to be complied with. We have also the peer-to-peer lending, which is called also the P2P Lending, which provides for interest derived by a person. Normally the interest will be included in the gross income, but any bad debts, any fees payable to the peer operator will be deductible from the taxable income on money lent through the same peer-to-peer lending platform, that is on interest received from money lent. So there will be no tax deduction at source, will be applied on the peer-to-peer interest income. Interest income received by an individual from peer-to-peer lending will be subject to income tax at the rate of 3%, and income derived by a person from operation of the peer-to-peer lending platform will be exempted from income tax for a 5-year period. Now, there is also the solidarity levy. There's been a change, that is, individual share of income from a society or succession will be taken into account in the computation of the solidarity levy. This will be with effect from 1st July 2019. And on the other hand, lump sum income received by a person by way of commutation of pension, death gratuity, or as compensation for death or injury will be excluded from the computation of the solidarity levy. And here, this will take effect from 1st July 2017, that is the date the solidarity levy was introduced. The law provides, amendment in the law provides for a double deduction for the cost of a fast charger for an electric car incurred by companies and self-employed persons. There is a fine-tuning of taxation of banks. You remember that last year, the levy now is in the VAT Act, but there's been an amendment to that levy because what happened, the levy formerly was on segment A and segment B. So what has happened in the amendment that has been done is that income derived by banks from global business companies will be exempted from the levy under the Value Added Tax Act. And there's been a small change in the rate of the levy has been increased from 4 to 4.5% of leviable income for banks having operating income exceeding 1.2 billion in a year. But there is a cap which will be applied on the increase in levy payable by bank in order to ensure that no bank is burdened by an excessive levy amount. Now, there are some fine-tuning which has been done also to clarify that the levy will not be a deductible expense under the corporate and the income tax. And there will be no foreign tax credit for banks. And as regard the predefined conditions for a bank to benefit from a reduced tax rate of 5%, this will be set out in regulations which will be issued shortly by the Minister. Now, there are some other changes which I will not go into details, but you will remember that we were being reviewed by the EU on the our Freeport regime. So because of to comply with EU requirements, a Freeport operator or private Freeport developer engaged in manufacture of goods will be liable to income tax at the rate of 3% on profit derived from the sale of goods on the local market. And there is also the manufacturing companies in the Freeport, they will be required to meet the prescribed substance criteria in order to benefit from the reduced tax rate. On the sale on the local market, the Freeport companies will be liable to CSR. And concerning the National CSR Foundation, this is being renamed as the National Social Inclusion Foundation, and the MRA has been given powers to raise assessment where CSR has not been spent in respect of the CSR fund. There is also one interesting amendment concerning company facing financial difficulty, which is taken over by another shareholder. They will be allowed to carry forward any unrelieved accumulated losses, provided conditions relating to safeguard of employment and other conditions imposed by the minister are met. Now, there is another interesting, I can say, for the hotels, expenditure incurred by hotels on cleaning, renovation, and embellishment works in the public realm. They will be able to deduct 150% of the expenditure from their taxable income. There is a change also in the residence for companies. Company incorporated in Mauritius shall be treated as non-resident if it is centrally managed and controlled outside Mauritius. And we have also for self-employed, you have certainly noted that self-employed with gross income not exceeding 10 million and engaged in activities that makes them eligible. There are some activities like agriculture, manufacturing, wholesale and retail of goods. So they have they're eligible for presumptive tax. But the presumptive tax, I think, is 1% of the gross income. So these taxpayers, they will be exempted from the requirement of the CPS payment. We have mentioned that, so presumptive tax, I've said, 1% of gross income as final income tax. But the company, they will be eligible to include if they have ancillary income from other sources, provided that such income does not exceed 400,000 rupees. Regarding, there's a lot of tax holiday, a 4-year tax holiday to company deriving income from bunkering of low sulfur heavy fuel oil, 8-year tax holiday to company deriving income from intellectual property assets developed in Mauritius after 10th June 2019. To benefit from tax holiday, they will have to satisfy the substantial activities requirement in compliance with the BEPS Action 5 report, and this will be laid down in the regulations. There is a 5-year tax holiday for the company setting up an e-commerce platform, provided companies incorporated in Mauritius before 30th June 2025. Peer-to-peer lending operator, 5-year tax holiday, and also 8-year tax holiday to a newly set up company developing a marina. Now there are the partial exemption is being extended, that is 80% partial exemption for income derived from reinsurance brokering activities, leasing and provision of international fiber capacity, sale, financing, arrangement, asset management of aircraft and spare parts, and aviation advisory services. So these are the main changes. Now I will ask my colleague, Mrs. Gunnoo, to just brief you on the main changes to the Mauritius Revenue Act and VAT Act.
Yes, thank you, Mr. Hannelas. Good morning, ladies and gentlemen. In the MI Act, the main changes regard the incentive schemes for small and medium enterprises. We have the voluntary disclosure scheme for SMEs. This is applicable to companies and individuals whose turnover for the year of assessment 2017-18 did not exceed 50 million. So they will be given the opportunity to regularize their situation by coming forward with a voluntary disclosure. They have up to 29th November to come forward with a disclosure, and they will be given the opportunity to regularize their situation without paying penalty and interest. They will have to pay only the tax. And this will be applicable for income tax and VAT as well. Also, we have a tax arrears incentive scheme, again, for those SMEs that qualify for the scheme. And for the tax arrears scheme, they will be given the opportunity, if they have outstanding debt as at 30th June 2018, which are collectible, then they will be given the opportunity to settle the amount without payment of penalty and interest. And the tax outstanding must have been as at 10 June 2019. That is arrears as at 10 June 2019. The other amendment in the MRA Act concerns the streamlining of provisions regarding appealed representation to the Assessment Review Committee, where delay for the submission of a statement of a case and witness statement is being provided, so that they will have a delay of 1 month, and then if a chairperson or the vice chairperson is satisfied, if there are any circumstances that warrant an increase in the delay, then this will be given. So these are the main changes to the MRA Act. And regarding the VAT Act, we do not have many changes in the VAT Act, except maybe 2 or 3 provisions that worth mentioning. There has been an amendment to Section 15 of the MRA Act. Previously, when the Director-General was satisfied that a person was resorting to splitting of business in order to avoid VAT registration, he could direct that person to be responsible for accounting VAT on all the supplies made by the other persons. Now with the amendment, all the persons involved in the scheme, the Director-General can request them to, can direct them to register for VAT, so that they will have to be compulsorily registered, notwithstanding that their registration threshold is, that their turnover is below the registration threshold. Then there is an amendment to Section 24 regarding the repayment of VAT. Previously, the VAT repayment, as you are aware, in respect of capital goods, was in respect of capital goods exceeding 100,000. So that, and this was specific, it was stated buildings and fixed assets, so that intangible assets were not included. Now the scope has been extended so that it covers intangible assets like goodwill, computer software, and patents. Then we have provision 63A, which related to the tax liability of principal officer of a private company. This was removed last year. It was intended to be transferred to the MRA Act, but then it was not transferred, so this has been reinstated so that principal officers of private companies are liable in case VAT has not been paid by a company. The other provisions concern mostly extension of the scope of exemption, zero rating, refund, so that they are quite straightforward. So I think that's all.
Okay. Thank you, Mr. Hannelas and Mrs. Gunnoo, for having this quick overview of the tax changes. I think what we've done, as I said, we've spoken to some of our clients. PwC has also looked at some of the provisions of the Finance Act and Finance Bill, and we form a view on some of the latest changes. Maybe I'll take the first question. It's around essentially peer-to-peer lending. I mean, as Mr. Hannelas said earlier, the government has introduced now a new peer-to-peer lending business, which is now considered as an activity, business activity. And what has happened is there is 2 sets of incentives around the peer-to-peer lending. One, there is a 5-year tax holiday for peer-to-peer lending income being derived. And secondly, there is 80% partial exemption on the interest income being derived from peer-to-peer lending. There is no real definition or guideline on what constitutes peer-to-peer lending. And I understand those would be regulated by the FSC. I'm not sure whether there's been discussions as to whether guideline would be issued. So our first question would be essentially what constitutes peer-to-peer lending, Mario? I mean, and any kind of indication you've already had discussion with the FSC on that.
Yep. It's true that peer-to-peer lending is not defined in the finance bill. There's also no definition of peer-to-peer lending in the Income Tax Act. But we know that P2P lending is a practice of lending money to individuals or business through online services that match lenders with borrowers. However, we are told that the FSE is actually working on the rules for peer-to-peer lending, which will soon be issued by the FSE.
Okay, because that was the question. I mean, from the reading of the finance bill, it seems to say peer-to-peer lending platform. And I think as Mr. Hannelas probably clarified, it needs to be maybe electronic. It cannot be I register myself. I don't have an e-learning, peer lending platform. I just lend money on a peer-to-peer basis. It's not very clear whether that would constitute peer-to-peer lending if I don't have an electronic platform, but maybe we'll need to wait and see for the legislation to come back. Another item is, how does the partial exemption regime interact with the 5-year tax exemption? I presume there's the 5-year tax exemption first, and then the peer-to-peer lending comes in.
As in the Finance Act now, 5-year tax holiday, yeah. But when we talk about interest, any company receiving interest, they are covered by the partial exemption. But your question is whether after that 5-year period there will be 80% partial exemption. If it is on interest income received by the operator, yes. But on fees, because I know that the operator, the company operating the peer-to-peer lending, they will usually collect fees. Normally there is a one-time fee on funded loans from borrowers, and then there is a loan servicing fees from investors. Mm-hmm. So this they are not covered actually by the partial exemption. It's only the interest if they have. From your question, I think you said interest. Interest, okay, it's already covered as a partial exemption, but the fees are not covered by partial exemption.
Okay, from interpretation of the TDS, typically interest, there would be an element of definition there, and if I remember well, in terms of TDS definition, it kind of refers to any prizes attached to the loan. So would those definition of interest have the same definition as per TDS to the peer-to-peer lending, or would it be more restrictive?
I don't know. What the amendment has said that there will be no TDS.
No TDS, yes. But to qualify for the 80% partial exemption, would the interest definition remain the same as for TDS, or would there be a kind of different definition at one stage?
No, the definition will be the same. It's only the fact that there will be you are right, maybe in terms of the TDS, that is because TDS is an advance payment.
Yes.
And when we did it for interest, it was at that time the rate was, tax was 15%. Perhaps we'll have to have a fresh look at this. Yeah.
Okay, and in terms of the substance requirement, the peer-to-peer lending also refers to substance requirement that would come into the guidelines as well, or would be similar to this?
It will be similar to the existing.
Okay. Maybe I'll pass to Dhiren for the next question.
Yeah, thank you, Tony. And Mario, you mentioned, in fact, on your expose, you mentioned that there has been an amendment to the claim for foreign tax credits, specifically for banks. And if you look at the legislation, this is something that was introduced last year as well itself. And this year, it's only a fine-tuning, I would say, if I look at the amendment. Conceptually, a foreign tax credit is available for any income that is sourced from outside Mauritius and is taxed in Mauritius eventually, right?
Yep.
So we were just wondering what's the rationale of introducing that restriction on bank. I know that most of the bank don't have other income other than banking transaction. Yeah, the first question is what's the rationale? Because at the end of the day, we also aware that you get foreign tax credit if an income is taxable in Mauritius. So in any case, we cannot deny that the bank is subject to tax on that income at 5%. So, yeah.
That's a good question. In fact, there is a rationale. If you will see that all companies that are taxed on, let's say they are eligible to partial exemption, they can't claim the foreign tax credit.
Yeah.
Either they are taxed at 15% and then they claim foreign tax credit, or they tax at an effective rate of 3% because 80% exempt, but they can't claim foreign tax credit. With the reform abolishing the deemed foreign tax credit, we now have a special tax regime for banks, which is a progressive tax system, 5% and then 15%. So when we had this reform, the purpose was to make sure that the banks, the reform is tax neutral. That is, formerly banks were being taxed at the rate of 15% on segment A and 3% effective on segment B. So it has been designed to ensure that the change in the tax system is tax neutral, that is, banks will not suffer additional tax, and also that our banks continue to be competitive. So as we have seen that the growth in the bank is more mostly from the segment B, so the tax on increased chargeable income from that segment will be only 5%, because we have given some special incentive, and so we have thought that there is no need for the banks to get that foreign tax credit. Why? Because if we take the example of a bank receiving dividend, they will be now taxed at an effective rate of 3%, because dividend from overseas, dividend from Mauritius is not taxable, but dividend from overseas, we could not extend interest to bank, because this would have been a big, let's say, shortfall in income for the government. So bank main income is interest. But if a bank receives dividend, I'll take, let's say, a bank that is being taxed at 5 and 15%, the bank gets dividend from overseas, the bank will be given 80% from 15% and will pay only 3% on the foreign dividend. If a bank is paying 5%, the bank will get 80% of 5%. Let's say there is no, the bank is a small bank, is paying 5%, will get still 80% of 5%, which is 1%. So with all these incentives, I think the incentives that are being given is to make sure that our bank can grow, but at the same time, to make sure that we comply with international standards, because you know that it was not possible to maintain the deemed foreign tax credit because it was, as they call it, it was fictitious, and we gave credit even if there were no foreign tax paid suffered. So I think there is a rationale in the sense that the income from overseas will only be taxed at a very favorable rate. So government has decided not to give any tax credit. It's the same, I think, formally. A bank could claim 12% deemed foreign tax credit, and it end up with 3%. Now they will have to pay on their foreign either 5% or 1%.
Yeah. In fact, I hear what you say, Mario. But we cannot ignore, perhaps, if I take 2 points on that, some bank may be taxable at 15% eventually if that chargeable income actually exceeds a certain amount. So eventually, if you look at you mentioned the progressive nature of the taxation, so one may say that eventually the dividend would be taxable at 15%. And In fact, my second point is the claim for foreign tax credit rests on two very good bases for Mauritius. Either you get the partial exemption, that's the first option, but we cannot ignore that if the actual foreign tax suffered overseas is more favorable, we have the choice to go for that actual. So when you're saying dividend, and we are all aware that dividend actually attracts underlying tax credit. So if a bank actually gets dividend from an African company, subsidiary, where potentially the tax rate might be more than 15%, then it would make sense that it should have gone for the actual. You understand what I'm saying? So at the end of the day, yeah, in fact, eventually you mentioned that the effective tax rate would be 1, whatever, very low. I understand the rationale. But we cannot ignore the concept that even the 1% in the previous regime, under the previous regime was not, in fact, the bank would not have paid that.
Yeah, you know, banks are very profitable businesses. Yeah. And you know that when the tax was 25%, at time we reduced it to 15%, and this was extended to all banks.
Yeah.
And what we have done, I think the government has made sure that our banks can compete with banks in Singapore. And I think everybody, you know, I was very actively involved in that reform. We didn't, at that time, we had a very big problem with banks because they were being given deemed foreign tax credit for segment B. And it was very difficult to find a formula that will satisfy the bank. And I'm sure now the banks must be very happy with the regime that we have actually. So I don't see them complaining about not having a foreign tax credit, being given that on foreign source income, they will be taxed at very nominal rate. You know that even the public, you can't have a system where banks, we know they were complaining that they were paying 15%, they were paying special levy, and they were paying, let's say, CSR. But now, the special levy, I think it was supposed to be temporary, but we have seen that it has become something of permanent. But we have found a solution for banks in terms of the global business companies, businesses that they have with global business companies will not be covered by the special levy. And also in the definition, what we have made is that if a company, for example, has got a permanent establishment outside the company, incorporated in Mauritius, has got a permanent establishment outside Mauritius, this will not fall within the definition of the resident. This will not be covered, and this special levy will not cover. I think that we have got some friends from the bank, and I speak under their correction. They are, and I'm told that they are very happy with it.
Okay. Thank you. So, in fact, we should be, the rationale is, it could be whatever, but at the end of the day, it's more of a package which the bank are happy. So, I understand what you're saying. So, thank you.
Okay, thank you, Kudir. And maybe the next question is around the global business sector. I see many operators within the global business sector, and I also have interacted with some of them before this session today. As we're all aware, with the new 80% partial exemption, there is a transitional regime that's in place. So essentially, all global business companies with a license prior to 16 October 2017 are grandfathered till 2021, June 2021. So all the new provision doesn't apply to those companies. There is a period between October 2017 and December 2018 because those companies were grandfathered till 31st of December 2018. But from 1st of January 2019 onwards, the transitional rules no longer apply. So essentially, the new 80% partial exemption now is fully applicable. But there are some companies with year-end, for example, 31st of March 2019, So they have 9 months of the old regime up till December 2018, so 9 months, and then 3 months under the new regime. How is the MRA going to be implementing this, and especially around the complexity around the tax return, Mario?
You know, it was not easy to, let's say, we were being reviewed, and when we had the law last year, the effective date, we put it 1st January 2019. We had no other alternative. We had to put it on 1st January 2019. And because companies with license after 16th October 2017, they are not able to benefit from grandfathering. So we have to apply the law as from 1st January. So if we take a company, let's say, having a closing date on 31st March, let's say the accounting is for the period 1st April 2018 to 31st March 2019. So 9 months, they will be able to claim under the previous regime, that is, they will be able to claim the deemed foreign tax credit on their foreign source income. And on local source, it will be 15%. So they will pay 3% on the effective rate, 3% on the foreign source income. Now, for that period 1st January to 31st March, they will be entitled to partial exemption on specific income that are mentioned in the law, and provided they meet the substantial activity requirement. We have made provisions in the return for the, that is a company, for example, closing its accounts on 31st March. They will have to calculate their tax for the 9 months under the old regime and the 3 months under the new regime.
Okay, so
there will
be a split and apportionment. Okay. Okay, I mean, that was a question that many of us has been asking, because when we see the split around what's attributable to export and what's attributable to domestic, there's automatically inbuilt apportionment in the returns, and I guess that's going to be the similar scheme within the tax return for the split, or would there be a possibility, because some businesses are cyclical, so would they be able to do it on an actual basis, or would it just be a pro rata based on the number of months?
We can do it on a pro rata if it is difficult. We recognize that administratively it's a burden for the taxpayer, for the company, as well as for the administration.
Yes.
But we could not do otherwise, because we wanted the law to take effect as from the beginning of the year of assessment, but it was not acceptable to the OECD.
Okay.
So it will be extra work for both companies and for the MRE as well.
Okay, thank you for this clarification. Maybe later we'll get a few more questions on this. So the next one to Dhiren, maybe?
Yeah, thank you, Tony. And in fact, as you mentioned earlier in your introduction, Mario, we have seen the introduction of a tax claim by hotels, equivalent to 150% of the amount that has been spent by the hotel. And it's quite specific in terms of, of course, it talks about cleaning Mauritius, embellishment works, but it is in the public realm. Sorry, this is the best I can do in terms of pronouncing. So my question is perhaps around the how is the MRA going to really address this issue? So if I'm a company and I have incurred expenditure on these cleaning and so on, how are you going to verify that from an audit perspective? And we know how the MRA is. They tend to, in some cases, really go to the details and
definitely, the hotels will have to keep appropriate documentary evidence for us to verify, but there will be some procedures that they will have to follow. So, being given that the whatever cleaning, renovation, and embellishment, it should be in the public realm. So, obviously, there will be an authority. It can be a beach authority, village council, which will have, the hotels will have to work with some authority. And MRA will come up with a sort of practice note or statement of practice just to ensure that hotel comply. Naturally, they will have to keep some evidence, but we'll have to ensure also that it is the work is being done for the public interest, and obviously they will not be doing work within the premises of the company, and it will be outside. So this will have to be, in fact, verified, and there will be some procedures. They will have to engage with some authorities. If they are cleaning the beach, for example, it will be the beach authority. And we, at the level of the ministry, actually, they are working on the procedures and will come up with.
I heard you mention beach twice. So would that be restricted to the public beach?
Because in the,
because
law,
I believe
it is not mentioned cleaning of beach also. It's only, it's mentioned cleaning, renovation, embellishment work in the public realm.
Exactly, So I believe it's around Mauritius, so to the extent that it is approved by the local authority. You mentioned for beaches, you're going to have the beach authority, and I believe the other part of Mauritius, that would be another authority. Okay, thank you for that, Mario.
Okay, the next question is around the Freeport. Previously, there was a regime which was essentially the taxation of export of goods at 3%. This scheme has now been extended to ensure that all Freeport operators and developers are now taxed at 3%. And the Freeport operator will be taxed at 3% even on their local sales. So what the question is, I mean, typically Freeport operators are geared to primarily look at export, but to the extent that some Freeport operators do maybe 60% local sales and 40% domestic sales, would those still be taxed at 3%, or are there anti-avoidance provision which would look at these things, Mario?
Yeah, maybe for the benefit of you, of all of us, it's important to mention that this has been brought in order to comply with the requirements of the EU.
Yeah, that's right.
Because the EU will not accept that we have, the ring fencing issue. We can't have a tax rate of 3% when you export and then 15% on the local sales. We know that actually on export, let's say a manufacturing company outside the Freeport, they are exporting and they are also selling on the local market. They pay 3% on their export and 15% local. We have not touched this for the time being because it has not, at the time we were discussing, it was a Freeport which was being subject to review. And I think it was important for us to clear the Freeport. So we have done this for the Freeport, but you know that even formally there was a sort of a quota. The Freeport company could not sell
exceeding a certain
but this also has been removed because of the OECD, because at that time Freeport company, there were services, I think global trading, the Freeport, which we had to remove. So once we got clear with the OECD will not look at manufacturing, but the EU continued to press on, and they had the similar rules in terms of ring fencing. But I'm sure my colleague, Mrs. Gunnoo, can tell you that it's not easy to sell from a Freeport if you have to sell on the local market, because and you have, because everything that goes on this report, you have the exemption of duty, VAT, and all that. But when it comes back, it's like as if you are importing again. So there will be definitely some restrictions. And I am told also that in future, the Freeport will not really do manufacturing as such, because when we change the law, they will continue to do some light processing and all that. And in terms of, I know that the risk is that if you want to get, let's say, an advantage tax, you just set up in the Freeport and you sell on the local market at 3%. So this can be a scheme to avoid paying 15%. Of course, we have our law provide for if you are doing something in our law, our GAR, General Anti-Avoidance Provision, it's provide that if a company is doing whatever transactions with the sole or dominant purpose of avoiding tax, we can use that weapon. But we can only use this GAR if we can establish that the company is doing it solely or with dominant purpose of avoiding or postponing payment of tax.
Okay, so I think from that it's clear that if companies are kind of arranging a scheme to avoid some of these tax, then it may be caught under those provisions.
Yeah.
Okay, so next one to Ren.
So let me turn to Mrs. Gunnoo now. So you rightly mentioned the if I may say, the reintroduction of the voluntary scheme, and of course there is a period that you need to adhere to really benefit from that voluntary disclosure scheme. We have the SME, but we cannot forget that you have people or individual who actually owns foreign asset as well, where you have that voluntary disclosure of income which is open to these people. Yeah, it is true that it's very specific in terms of who is eligible under the law to benefit from that voluntary disclosure. Administratively, and I think I'm pressing on that word, is there any possibility that you extend that to any other person other than those mentioned in the Act, so that it's a fair system to everyone? Because if I'm a large company, I have complied with everything in terms of tax, made my return, disclosed everything, and it happens so that there was a miss or whatever, genuine, then it's a bit unfair that I don't benefit, and someone who has in fact not disclosed his income in the past intentionally is going to benefit from that exemption from penalty and interest. I understand that it is a matter of policy, but of course I'm just going to, I said administrative, whether there is any scope.
Maybe it's appropriate that we understand the concept, the context in which this scheme for SMEs has been introduced. Since a few years, we have been, last year, in fact, we have been engaging with SMEs in the SME partnering program, and so that we enhance the tax compliance of SMEs. We have received representations that non-compliance in the SME sector is often due to ignorance of the law, or they do not have appropriate necessary resources to look at their tax affairs. And very often they have been misguided also. So it is in that context that the incentive scheme for SMEs have been introduced, and you will see that in the definition, the professionals are clearly excluded.
Yeah.
So that it is made for those who have been endeavoring to do some business and are facing difficulties. Yeah. But then, so that your question about the large
companies,
those companies above 50 million, the turnover
anything
is
above 50.
50 million, you know that they are required to submit audited accounts, so that they do have a means to ensure that their tax affairs, they are complying with their tax affairs.
Yeah.
But I would say that even now, if a taxpayer finds that something has been, they have underdeclared something not deliberately or negligently, they can come forward to the MRA, and then there will be no assessing penalty. So that provision will still apply, and depending on the circumstances, the Director-General, in specific circumstances, there is provision for the Director-General to waive a penalty, so that could apply to the assessing penalty. There is a question of law, or they can explain the circumstances in which that income has not been declared or that expenditure has been overclaimed. Then the Director-General would consider the waiving of the penalty.
Yeah. In fact, I understand what you're saying. And in fact, it's highly appreciated from a SME perspective that the MRA is really helping these type of companies to come forward and to increase their compliance. But the thing is, well, we're not saying that we represent the large taxpayers or perhaps the medium, which doesn't normally include the SMEs, more than 50 million, I mean to say. There are cases where, in fact, we have legal issues as well, where potentially there is, at least before going to the court or whatever, getting a legal opinion, it's not really a clear-cut issue whether it is taxable or not. Then in those cases, I believe, as you mentioned, the MRA actually try to waive the maximum amount of penalty.
Maybe it's also good that we know that we have tax ruling. You can apply for the tax ruling, so that if you are in doubt. And then as from last year or the year before, we do have a provision where you are in doubt. You can say whether what is the issue, and then there will be no penalty. So there are provisions to address this issue of uncertainty.
Yeah, rightly so. Yeah, thank you for that.
Okay. Maybe now a question to Mr. Oozeer. I mean, the Finance Act last year introduced maybe a 10% ban on personal income tax, and I've noted there's been some further refinement to the threshold and the mechanics of that 10%. Are you able to clarify a little bit more? Because in the past it was just a threshold. Once you've passed this, it's a no. But I guess it's further refinement to bring a little bit more flexibility around the scheme.
Yeah, you're perfectly right. I mean, this was introduced last year, where an individual has a net income not exceeding 650,000. The tax rate was 10%, and when it exceeds 650,000 in a year, the tax rate is 15%. Now, what has been introduced this year is an exception where an individual derives a basic salary plus salary compensation for the month of July, not exceeding 50,000 rupees, and in such case, the individual will benefit the tax rate of 10% for the whole, for the year. I mean, why I'm saying for the whole year, it's because there is a difficulty about applying the exception for PAYE purposes, because once the employee gets the basic salary not exceeding 50,000 rupees for July, of course, the employer will apply 10% for the PAYE of July. Now, for the next month, even the employee derives more than 50,000 rupees, but it should not exceed the equivalent of 700,000 rupees a year, which is 53,000, I tell you exactly something, 53,846, then the 10% will continue to apply. So, to summarize, it's that if an employee derives basic salary of 50,000 rupees, 10% will apply. provided the net income of that employee doesn't exceed 700,000 rupees.
Okay, thank you, Mr. Oozeer, for that clarification. Maybe one question from me to Mrs. Gunnoo. Earlier you talked about the repayment of VAT on intangible asset, more specifically goodwill. And I think the way the drafting of the provision refers to goodwill on acquisition of business or part of a business. In general, there's that provision which says to the extent that a business have been sold on a going concern basis, no VAT would be applied on that. And generally, goodwill arise on the sale of businesses. How does the provision interact with the repayment of VAT to the extent that there's a going concern transfer that has happened on a business? I understand from the MI perspective, they have different views on how transfer of going concern happens. It needs to be the whole business rather than part of the business. How would those interact these days?
Well, if there is the transfer of a whole business as a going concern, then Section 63, I think, would apply, where there would be no VAT. It would be a transfer. The other person would have to be registered.
Yes.
Regarding the issue of a part of a business, this is not covered. Our legislation is different from, let's say, the UK legislation, where even part of a business, if it is transferred as a going concern, there is no VAT. Whereas here in Mauritius, you know, when the VAT was introduced, it was a rather simple piece of legislation, so that the issue of transfer of part of a business has not been catered for as a going concern, so that VAT will have to be paid where there is transfer of part of a business. But now provision has been introduced so that there is the issue of goodwill, even for part of a business, when the goodwill, there could be repayment, because that is a substantial amount which previously was not covered for repayment purposes.
Okay, but the way I read it, it says goodwill on acquisition of a business. So does that mean even if you are selling a business as a whole, there's an implicit understanding that there would be a VAT on that? Or what? Because it says goodwill on acquisition of a business or part of a business. Part of a business, I can understand, but why do they have the acquisition of a business? Because acquisition of business means the whole business.
But then Section 65, 63
would
will override.
Okay. Thank you for that clarification. And maybe sometimes what we get when there is a partial disposal of a business, there's different interpretation as whether we need to apply it on the total sales proceed, or do we break it in individual components? For example, we apply it on fixed asset, on cash we don't apply. What's the interpretation around those sale of businesses?
We have given several rulings,
yes.
I think, in respect of that issue, so that, in fact, we have to look at the facts of the case and to decide which provision to apply.
Okay. Thank you for that.
Yeah.
Maybe Dhiren?
Mario, we have been, whether we like it or not, we cannot ignore that the tax environment in Mauritius has greatly been influenced by whatever the OECD and the EU or the international bodies have done. And we have recently seen the introduction of the CBCR, in fact, it's a country-by-country reporting. And the budget 2019, with the budget 2019, we saw the introduction of the CFC rule. So are we going towards a tax system in Mauritius which is completely compatible or perhaps in line with what we have internationally? Are we looking towards the introduction of, in the near future, of transfer pricing legislation? And why not, if that is the case, why not the group relief as well?
Yeah.
A tricky one, but
No,
without any commitment.
These are policy decisions, and as you know, even on the Section 75, there has been mentioned that there would be some changes, but you know that we have a technical working group which has been set up when we had the review from the OECD. So at the technical working group, probably this will be on the agenda. Do we need transfer pricing legislation? And I know that having spoken with some of the stakeholders, some are for, some are against, and there will be discussions. This will have to be discussed with the stakeholders before there are some people think that what we have is enough. Others say no, we need no clarity. So we need to have a consensus. So this will be discussed at the level of the technical working group. Yeah. Now, when you mention about group relief or international, it's true that in certain countries they have group relief. I don't know, this is a policy decision because we will have to see what is the cost in terms of the forego, what revenue we'll have to forego.
Yeah. It's always a balancing act.
So it's not really administration, it's policy. But when time comes, we will be involved, and you also will be involved in the discussions.
Yeah, because let's admit, it is true that it is a policy decision, but of course the MRA can influence, I believe. And,
we are only administrators. Yeah. It's true that we work with closely with the Ministry of Finance, but at the end of the day, it's decided by the government, and once it's decided, we have to implement. But we naturally will form part in the discussions, and we will have our views and our input.
Yeah, because if you look at the group relief, we cannot ignore that from a VAT perspective, when you merge everything, it actually makes sense, and this is something that potentially the industry would be very happy to.
I am sure that Mauritians, the business community, will like to have group relief, but there is a cost, and as you said, balancing act, government will have to.
Yeah. Maybe some of the taxes on VAT, it's less of a tax leakage because the total collection remains relatively the same on a group basis. But from a corporate tax perspective, I understand that balancing act is needed. Okay, maybe a last question I'll take from us, and then I'll open the floor. And I'd like to touch on the global business sector again. I mean, that's a sector which has gone fundamental changes and is continuing to face challenges. One of the reforms that has been introduced is around the 80% partial exemption on certain specified income. Here, as we look at the drive to bring more substance in Mauritius, global business license companies will be employing people, will be putting activities and putting substance. As a result of that, they will be building costs, which essentially they won't like to charge or sell to other group companies or other companies around the world. And what we can see now under the new provision, income from services are not included as part of the 80% exemption, while before those income were subject to the 80% deemed partial exemption. The 80% deemed tax credit. I know there has been a lot of industry consultation on the matter, and we have seen that not only the budget, but also the finance bill has been silent on that. Are you able to update us a little bit on those discussions, or has it been put on hold?
You know, we already have a tax rate of 15%, which is low compared with other countries, I think. The it's true that our global business, the effective tax rate was 3%. And the way we had defined foreign source income, we had a rather strange definition in the sense that it was not in line with the other company for global business. It was even local source income were sometimes considered as foreign source income. And we've seen that many services also were being included just to get that 3%. The problem is if you put 3% on a particular, let's say, consultancy services, you have to extend it to all consultancy services. And if you take accounting services, you have to say all accounting services, tax 3%. So where do we stop then? Are we able to put a rate of 3% for our income tax? This is the big question. And as you may be aware that internationally, although at one time they were not talking about a tax system, now they are coming back. It was said that you, as a country, you are sovereign, you can have a tax system, zero tax, or give tax holiday, or even have only indirect taxes, no income tax. But I'm sure if you are following what's happening on the international scene, they are coming back with the idea of minimum taxation. And we have, in fact, delegated somebody to go to Africa on ATAF discussions on this was the subject of minimum taxation. Mauritius was the only one saying that, you know, we don't like this idea of minimum taxation, and we want to have a carve out if we are cleared by OECD and by OECD, so we should be like sort of exception in that minimum taxation. But they are coming with a discussion. I don't know what form that will take, but apparently the international community is becoming very political in the sense that they are not, even with the BEPS, they thought that they would be able to, in fact, sort out everything. But now they are realizing that many countries are clearing their system. And so I don't, by the back door probably, they have used now the Action 1 on digital economy to discuss about minimum taxation. And when I raised it in France, they said that it's only at discussion level, they are exploring it. We have not yet decided. So, but the way things are going in international forum, a lot of discussions is going around minimum taxation, and I don't know if it will be in the interest of Mauritius, and can we afford to have a tax of 3% only? I don't know.
Yeah, I mean, we certainly were having an interesting debate before this this forum about, you know, there's a minimum level of tax depending on the usage of that tax collection. So economies which has high benefits or high health sector, they tend to have a higher burden to service those. So yeah, so minimum tax will be relative to the public sector lending. Okay, so I think I have more questions, but I think to give the audience the possibility to ask a few questions, I now open the floor for questions. So who, I know some of you has been pressing, so there you go. Thank you.
My question goes to Mr. Hannelas. Just for clarification in respect of potential regulation to be coming out. Okay. Firstly, in terms of rates, so we have seen the introduction of rates. Companies operating as CIS or CEF can also operate as a REIT. Are we going to have regulation in that respect so that we know, we understand the framework in which the companies operate? That's my first question. Second, in terms of substance requirement, I know the budget say that we'll have more substance requirement, enhanced substance requirement. So my question is, by when we can expect to get the regulations? And thirdly, you mentioned about Section 75, also by when we can expect to get the regulation. So really just in terms of regulation for those 3 items. Thank you.
Yeah. For the rate, we are working on the regulations. It will soon be it should soon be out, and it's probably not proper for me to give the details of what will be in the regulation, because still there are discussions, and but there are certain, we are working on it, and then substantive requirements. I know that you are aware that in certain regime we have specified the number, minimum staff and minimum operating expenditure. I think that in Treasury, headquarters, we will have it for Freeport also, because manufacturing, you can't expect somebody to do manufacturing without having a minimum number workers in terms of qualified personnel. We don't want to be prescriptive in the sense that putting a sort of a number minimum, because you will see that in partial exemption, if we say you get 3%, the 80% exemption on interest or on a specific income, you may have the level of income will not require you to have this minimum. So what we have said that a minimum, it will be depending adequate number of an adequate. So we have not specified a number of staff. This has been done on purpose, but of course it will depend on the company claiming the incentive. It depends on the volume of transaction. It depends on the complexity, on the nature of the activities and all that. So it will be on a case-to-case basis. We don't want, it is important that we don't put a minimum number, because it's easier for the peer, when they do the peer review, if we fall short of that, we won't be able to give it to our, so that's why we have in fact avoided this. We can put it on certain regime, but not all regime. Okay, and there are also some regime that are being used, like for example, if a company has equity holding, is mainly primary equity holding, I think the substance in terms of staff, they are not really that important. It's more in terms of satisfying the rules, the Companies Act law and all that. And your other question on Section 75, it's true that we were planning, it's not a sort of a one-way traffic where income tax, the minister announced that there will be changes and then we work on the regulation. It has to do also with getting the inputs from the stakeholders. So I think that Section 75 will not really come after having a proper consultation with the stakeholders. And we have a forum, we have the technical working group where we can discuss and get the views of the stakeholders on this.
I see that there is an amendment to the VAT Act which reinserts into the law something that existed a couple of years ago, being the personal liability of officers, including executive directors, for non-payment of VAT. And as far as I remember, that provision of the law existed and was removed a couple of years ago. So my question is, and I've got a view on this, so for the couple of years during which there was no such provision in the law, if there was a VAT liability that arose, let's say for the financial year 30 June 2019, would that provision now act retrospectively so that a director who was director in this last financial year would be liable? So that is, and that's probably the easier part of the question. If the VAT liability arose at a time when the amendment was not in force, But maybe the more difficult question is if there was VAT liability arising previously, so let's say 10 years back, when we had similar provisions making directors liable, personally liable for VAT. Because as we know, a lot of that VAT liability maybe has not been paid as at today. And as far as I know, and as far as I've been dealing with one specific case where I understand that the MRA has objected to a company being wound up in relation to that because there was VAT liability that was pending for a couple of years back. But let's forget maybe about the last part of the question. So my question is, in relation to these few years, would that apply retrospectively? And then would that apply retrospectively further back?
Yes, in fact, this provision was last year. It was meant to be transferred to the MRA as I submitted, but then it was not done, so this has been reinstated. And my reading of it, because the effective date, I think, is the date of gazetting, if there is an outstanding liability now, a VAT liability now, the liability is outstanding, this provision would, this is my view, this provision would apply. But if there is a dispute about that, then we'll have to seek advice. But my view is that it would apply.
My view is probably it would not apply. The Assessment Review Committee, I suppose, will have to decide.
Yeah.
State Law Office.
Thank you.
There's one just past the microphone at the back. It's just behind you, and Sophie on the other side. Okay. Nice. Okay, let's take this one and then we'll take it for Joe. Joe. Yeah.
Yes, thank you. Are you able to share insights into the requirements for the e-commerce platform to benefit from the
exemption,
the 5-year tax holiday?
I think it's the 8-year exemption.
Yeah, exactly.
On the e-commerce platform. So what the requirement is, it's an 8-year tax holiday for companies setting up an e-commerce platform in Mauritius, and is a holder of an e-commerce certificate issued by the economic EDB, subject to certain substance requirements.
Yeah. You know that in terms of, let's say, tax incentive, it will be a preferential regime. And to avoid, let's say, being termed harmful, because any of our regime now will be reviewed by either OECD or EU. They have, the OECD, for example, they have experts, they have a secretariat that goes over all our changes in our legislation. They are already aware that we are introducing tax holidays. So they will expect us to have, to comply with the substance requirement in line with the concept paper that was issued in 2017, I think. We were a part of that when the concept paper was being developed. And we will have to ensure that the activities, the core income generating activities are being done in Mauritius. So it will not be possible for us to get a tax holiday if the core income generating activities are not being carried out in Mauritius. So we will need to have the qualified personnel, and we will need to, the company that want to benefit from the tax holiday must have the staff and also must incur a minimum operating expenditure to be able to benefit. Otherwise, we will not be able to give the tax holiday. Formerly, we had tax holidays, but we did not have this substance requirement. Now, for every tax incentive that we give, we have to ensure that the activities are carried on in or from Mauritius. Yeah.
Okay, I think there was another question here. Yes.
With the permission of the panel, I just don't want to talk about the Finance Act. We have a hot potato in our hands, most particularly the tax return for year of assessment 1920, and I have some questions on it. Can I have the permission to talk to us?
Okay, yes. We may not have the whole answers, but yes, go on.
As you are aware of tax filing, the deadline is tomorrow for entities having their end as 31st of January, and tax returns for domestic companies are still not yet live, neither on the MRA platform nor on the MNS platform. Grateful if you can see to it that those returns go live, because tax filing
I can assure you that any company, we don't have a lot of companies with year-end 31st January, but they will be able to submit their electronic return. But this I can assure you. Yeah. Okay. You know, there is still a lot of fine-tuning to be done, because we have had a very, I will say, it was long discussions with EU and OECD on these requirements. And I must tell you, I know where probably Joe is coming. We have always tried to simplify our tax return, and Mauritius has been rated very high, let's say, on ease of doing business. We always want to simplify our return, but we have to strike a balance between being simple and also complying with international standards. And what we don't want to fall short of being non-compliant. You know, the way the OECD work, when I talk of OECD, we are not a member of the OECD, but we are a member of the Global Forum, we are a member of the inclusive framework. And it is very important that we go as a member, we sit there to watch, to take also, we are part of the decision, to take the decision. And we always, normally, we work for the interests of our country like other representatives. But when it comes to, let's say, the BEPS action plan, and we have, Mauritius has committed to comply with Action 5, that is, not to have harmful regime. And when we know they are going to do the review, and what we want to have in Mauritius is to have a robust system, monitoring, so that, as you know, most of you are accountants, you know that when you have a good internal control system, you can reduce on the tests that you do. So we are not going to review our system. Other countries, peer review, other countries are going to review our system. So if we can have a robust system, the level of testing will be less. So that's why we want to have a system that we can capture the information, that we can tell them that, look, we have the system, and they can rely on our system. So Joe probably is coming on our return. It's true that on the return that we have designed, we have questions on substance. It's natural that we should have questions on substance requirements in order to see whether the company satisfied the requirements to be entitled to the tax benefit. So we will be glad to hear your question, Joe.
Most particularly, this concerns the part on chargeable income for companies claiming the 80% partial exemption. One of the questions is the number of hours of work the service providers are dedicating to manage the activities of the company. May we know the pertinence of this question? Because this, when you ask a general question like this, there are many factors that we need to take into account. For example, the quality of staff, the number of staff that a management company has. For the same company, a management company may may take X hours, and another management company may take Y hours. So I want to know the pertinence of this question on the number of hours that the service provider are dedicating to manage the activities of the company.
Yeah. The good answer, good question, and I think it's very pertinent for us to. It's a pertinent question because we can have a company claiming a tax benefit. They have their own staff. They will mention number of employees that they employ. Now we may have a global business company that does not have any staff or have few staff. They will mention. Okay, this we can check also. But we know that we have been saying that when the substance requirements were being discussed, initially on that concept paper, they were insisting that companies benefiting from a preferential regime should have staff within the entity. We fought against this. We said, no, it's not possible because our model, we use management companies here, and the company, what we think that the employment criteria can be within the jurisdiction. That is, the core income generating activities can be done within the jurisdiction, and we will give them the tax benefit if we are satisfied. So this is why when a company uses the service of a management companies, we are asking for the number of hours of service. Why? Because we know that when you are going to charge that company, you will have a system. And my understanding is that very often you know what has been the service that you have done in terms of hours of work also. So we are getting this on our self-assessment return so that we can aggregate. You know, it's very important for us because in terms of income tax, the information that a company gives is confidential for the tax. We will never give information to the OECD Secretariat about X company, Y company, Z company. We give them statistics. And when we get the information, we will prepare statistics so that we can satisfy the OECD that we are in line with whatever commitment that we have taken. So it was very important for us to get those statistics.
Now, does the MRA have a benchmark on this number of hours? How many number of hours may be considered good or not?
We don't have any benchmark, but you know that even at the MRA, when we were discussing at the OECD in the forum, we said that you said full-time. But what is full-time? In certain countries, full-time can be 50 hours a week, 60 hours, 40, 30, 25. Even in our country, in Mauritius, we start working at 8, we finish at 5. Rodrigue, we can start at 10, we finish at 2. It will be considered a full-time. So, no, it's true that in countries
there's no one from Rodrigue.
I have been, for example, I've been studying in France. When I was in Paris, c'était métro, boulot, dodo. Les gens sont they were very quick. But I went to Aix-en-Provence, in the south, near Marseille. Les gens sont comme nous, un peu plus slow, mais maintenant les Mauriciens deviennent beaucoup plus rapides. Parce que je vois, même at 5:30 in the morning, you see activity, and which is not the case in Rodrigue, which is not the case in Seychelles, which is not the case in certain countries. So, but you can't have one size fits all. But if you have some information, at least you can work on it and prepare the case for Mauritius.
On the first page, we have a question for, this appears on the tax return of a global business company. Did the company derive foreign source income during the year? May I know why we are asking a global business company to specify whether the company derives foreign source income?
You know, even global, now I know that with the fact that we don't have a regime particular to global business, and then what we call domestic. For me, all our companies, even global business companies, they are resident companies, so they should be treated in the same level. Whatever standard question that we ask a company, it should apply to all companies.
Okay. Kamal?
Mario, now that we have complied with the EU, the OECD, I'm not going to ask what's next, but can you please tell us how confident are you that we will be removed from the so-called grey list and be cleared? You have introduced the CFC, outsourcing. There was a question on the de facto ring fencing, which I'm not sure whether this is still pertinent or not, but probably you will need to get the statistics. And are you confident now that we will be cleared?
We have done everything that need to be done, and I think that we are just waiting for a good result, for a good news, but we never know. You know, there are some forces, like you have seen the Mauritius leaks and all that, so sometimes perception and reality, so these news can definitely influence those who will take the decision, but we are confident that we have done everything that need to be done, and so that we get whenever this, because the decision will be taken by the Council of Ministers. I know we have, you know, at the EU, it's not like at the OECD. At the OECD, there is a forum. We are member of the forum. It's true, it's consensus. But when our regime is being reviewed, we can talk, but we can't vote. But we are not part of the EU. The EU listing process is different. They review our regime, and then there is a technical, which is called Taxud. We engage with them. And we also meet the Code of Conduct group. I personally have met the chairperson of the Code of Conduct group, which they were asking for questions. We have been engaging with them. And from our interactions with the people from the EU, we are confident that we are on the right path. And there we are just waiting for the confirmation. I don't know. We have to cross our fingers, because we cannot really be certain until we get the confirmation that we are okay, that we are being, but we only will be removed. We have passed the law. We need to have the regulations. They are waiting, because there will be a meeting, and we will have to send them. I am in direct correspondence with the contact person there. We are preparing the regulations so that we can submit all the documents, and hopefully we will be cleared like we have been cleared with the OECD.
Okay. Just one follow-up question. Actually, it's a separate question based on the new tax return. We know that a majority of GBCs or GBL1s in Mauritius are investment holding companies, which a lot of those questions do not apply. So don't you think that it would have been appropriate to sort of make like companies other than investment holding companies please answer those questions? It would have made it much, much simpler.
Yeah, maybe we take note. I understand that some companies, if they are pure equity holding, probably we will not really, the substance requirement in terms of employment and will not really be of importance. We can think about it, and we'll take on board. I'll take note of what your suggestions.
Okay, thank you for that.
Mr. Hannelas, I've got a question on partial exemption for this substance. Can this substance be applied to a group of companies, meaning one GBL satisfying everything, and then the sister company sort of figure right on that to gain the partial exemption?
It's a group substance.
We don't have group taxation. Naturally, if we have many companies within a group, I think they can arrange their tax affair in such a way that they complied with because
So the
sometimes,
group-wise-
even if we don't have group, we don't have group taxation, we actually have shared services, we actually have Mauritian companies, they use the labor force of the other companies within. Yeah.
So that's
yeah.
fine then.
Yeah.
Thank you.
My question will be mostly a clarification on the definition of leviable income for banks, right? So as per the definition, we have to apply the tax, no longer the tax, on the net interest income plus any other income before expenses,
Yeah.
right? So what we understood based on previous meetings we had with MRA, that this levy will be applicable on the gross fees and commission. Right. But what we fail to understand is that the mechanics of the fees and commission is the same as the net interest income. You have to incur the expenses in order to generate the fee income. So what is the rationale of applying this levy on gross fee and commission income instead of the net fees?
You know that VAT is on the turnover, okay, on the sales, it's not on the net. But we had a sort of, for interest, we could not take the gross, we've taken the net, because this is the main income of the bank. But on other income, we had to take the gross. You know, probably it's not some people may think that we have removed the special levy. We had to remove it from the way it was. It was impossible to have a regime that satisfied the EU and the OECD if we keep the special levy in the income tax. The VAT is more a consumption tax. It's more our resident, our people in Mauritius that are paying. So we wanted to place it in and the VAT is actually not under the radar of the OECD or the EU. And we could have said on all turnover, which would have been within that is the philosophy of VAT, but we knew we could not. For example, we wanted to have all resident, but we knew that this would have been very hard on the banks. So we decided to exclude the GBL companies, which is, in fact, if you look at the VAT Act, there are many exclusions for GBL companies. And so in line with that, we have done it. And for the time being, I think it's going to work. And we will not be able to put income tax in VAT. This obviously we won't. If we were able to say we just transfer what should have been tax and the income tax to VAT, it will have been, we will have been taxed of there is a trick that, and if we are being questioned by an authority, we will not be able to stand on our feet to defend that system.
No,
now we are confident that if ever there is any question, we will be able to answer and defend.
Yeah, thank you.
But I think before there was a question of balancing and neutrality of the old system and the new system. I guess the calculation has been done to ensure that there is no net significant increase in the effective rate, Mario, I guess.
Yeah, there will be some banks, very marginal. We won't affect, we don't want a bank to find itself in a difficult position whereby they have to close their business and we are going to lose.
Okay, thank you for that.
So I have one question. Let's say, for example, if we have a manufacturing company in Mauritius exporting through customs to foreign countries, but for further processing, but invoice is done to another Mauritian company. What I understand is that the company will be taxed at 15% instead of 3%. So what is a rationale for this?
It's only when there are export and that we will
They are exporting through customs to another foreign company, but the invoice will be done to another local company, Mauritian company.
If I just may rephrase that, the issue is, in substance, what is happening, the goods are actually leaving Mauritius, Mario. But the thing is, they are part of a group of companies where the billing is being, or the invoicing is being done by one local company to another, which eventually would be equalized or rationalized somewhere within the group.
Yeah, because,
but in substance, what remains is that the goods are leaving Mauritius.
But we have
no.
Difficult to, you will have to, you know, if let's say we accept this, then we open the door to any, we'll not be able to, we have to satisfy that it's exported.
Yeah. So I think the answer would be, if I may say, everything should be in line in terms of, when I'm talking of the documentation, it should be in line with whatever happens for exporting, for when you're actually exporting goods, right?
Yeah.
So the billing should be outside, perhaps. Yeah.
Maybe
because ultimately the goods will not be consumed in Mauritius. It will be consumed overseas. It will be sold to foreign customers.
I may add that we have similar issue for VAT also, but then we look at the entity that is exporting.
Yeah.
It's the entity that is passing the bill that is considered as export, so it would be the
second
same
company.
issue.
Because it's a group. If you're invoicing to the other, eventually there is export now.
Yeah, yeah.
So whichever company is exporting will be benefiting from the 3%. I think from the point of view of the group, you will not lose. You will still be.
Yeah, but the only complexity with this is that the billing entity and the beneficiary of the 3% may not be the same. So there would be a disconnect between the financial statements that's been reflected and the effective beneficiary of the scheme. But I think probably this is something you may have to discuss more closely with MRA to understand a little bit more for them to be able to form a view, I think, Mario.
Yeah, because I don't see where you're being penalized from the point of view of the group. So you will have to explain to us, and then we'll see whether there is a solution for your problem.
Because one company will pay tax at 15%, whereas the other one will pay at 3%.
Okay.
I have a question regarding leasing. I believe there is some exemption on leasing, and we would like to know the criteria, how we can enjoy those exemptions to be taxed at 3% rather than at 15%.
Is it on leasing? No, it's specific. If you read
specific?
the law, it's specific on.
Yeah, I think the way the leasing provision was done is that in previously it was on leasing of aircraft, and I think now it's been extended to sale, arrangement of financing, as well as spare parts.
And then there is leasing and provision of international fiber capacity.
Company. But
so it's not leasing in general. No?
But
they are.
The question is, why leasing of aircraft or ships is being exempted, but not leasing of satellite?
Probably there was not enough representation made, I think.
Probably if there are, maybe in the future you'll have to, this is a good one, satellite and...
I think we discussed that, Mario. Yeah.
Okay, I think we're running a little bit extra. So I think what I'd like to say is to bring this special forum to a close. I'd like to thank our speakers today for making a special effort for coming and meeting us, and all of you, the audience, for having come and sparing this morning with us, and especially that this week has been disrupted by the public holiday yesterday. So thank you everyone, and I hope you've enjoyed it. Thank you.